Trey, we've put on this conference, I think, for almost 30 years. And if you make it a little bit better every year, at the end of 30 years, it gets to be pretty good. Good for a bunch of reasons. You make mistakes, you learn what doesn't work, and you throw those away. Better, however, because you build a franchise. We have a returning cadre of attendees in the live conference, over 300 strong, in the live stream, over 400 strong, that come back year after year. You know, Trey, because you run Wall Street. But in a conference like this, the idea that all of the wisdom emanates from the dais to the crowd themselves has an awful lot of wisdom. And what's made this conference work for 30 years is the franchise built around the audience and the audience first. That's worked very, very, very well for us. I have a great staff, some of whom have been with me for 30 years, which is to say they were at the first conference, they're here today. So I can worry about making the content of the conference better, while the whole back end of the conference is taken care of by veterans, which allows me to concentrate on what delivers better content value for the attendees. I suspect that people have harbored, well, let me rephrase that. I suspect the people who are attracted to this conference have harbored those expectations for years, but they haven't had the courage to express them as a consequence of the fact that gold's advance has been muted. But that's interesting, because I remember 2 years ago at this conference being asked by one of the people in the audience, and Trey, I scratched my chin sagely, and I said, I think gold's going to move in the year 2000. It's up 9% compounded for 25 years. People's expectations, I think, were inflated as a consequence of the decade of the 70s, and the fact that an asset class was up 9% compounded didn't register to people as a move. 50%, now people are getting interested, and the consequence of that is that they have the courage to make other projections, which I believe they harbored all along. I'm not, because I was surprised that gold hadn't moved further, faster, earlier. My belief, and Trey, you and I have discussed this over dinner, my belief is that gold does well when people are concerned about the maintenance of their purchasing power in US dollars. I've been concerned about that for a very long time. The arithmetic that concerns me is not expressed by the CPI, which I don't think is a good index hitherto. I didn't know, as you know, because we talked about it, when gold was going to move. But it seemed to me like an inevitability. As you and I both have talked about, I have a flaw in that I often confuse the words imminent with inevitable. But no, I haven't been surprised at all. I think it's way overstated. When I talk about the deterioration in purchasing power of the gold, I'm talking about in an absolute sense, not in a relative sense. I think relative to other currencies, gold will do well. Franz Pick said there's a lot of ruin left in a country that's great. Ruefully, I agree with that. I believe that gold will be the world's reserve currency for the balance of my life. For the record, I'm a healthy 72-year-old. But I think its hegemony will reduce. When I look at
the dollar's hegemony.
Yes, it'll be reduced. I think the U.S. government is doing their best to destroy the U.S. Treasury as a savings instrument, politicizing it, debasing it. But what are the alternatives? Our friend, Doug Casey, once said the dollar is an I owe you nothing, but the euro is a who owes you nothing. And I mean, the other analogy is the Prius mare at the slaughterhouse. I'm not concerned about the dollar relative to other mediums of exchange. I'm worried about the dollar as a storehouse of my own wealth. I personally trade, and I'm telling this to your audience, you know this. I personally save in gold. I personally maintain liquidity in dollars. Those are two different statements. Precisely what happened to me in 2010. Now, I didn't catch the top. I never do. But there were other circumstances where stuff appeared to me to be much cheaper. The consequence of that is that I made the swap. I do consider gold to be a form of liquidity, because I've proven to myself over 40 years that when the time comes, I'm not psychologically indisposed to selling it. One of the things I do, which I think your audience might find of interest, is that beginning in the year 2000, that was a momentous time. I had a discussion with myself. Where did I want to go? What did I want to do? One of the things that I began to do was to keep an informal alternative ledger in gold. My net worth, my income, my expenses in gold, rather than in the US dollar. And for that part of my ledger, when I look at what things cost today, I wish I'd been all in gold. Some stuff like rooms at this hotel, or a Big Mac, or a car, are really cheap. If you measure them in dollars, they're anything but cheap. But understanding that the dollar-gold exchange ratio was $250 to an ounce of gold at that point in time, if you equalize the numerator and the denominator, if you measure your savings in gold, you're struck by the deterioration in purchasing power of the U.S. dollar, and you're surprised by the steady reduction in the actual price of many goods and services on a global basis, if you're valuing them in a constant. It's a really interesting consciousness-raising exercise. Gold for me is insurance and savings. Gold stocks are investments. I don't own gold to make money. I own gold to maintain liquidity and maintain my purchasing power. I'm good at buying gold stocks. I've worked at it for 50 years. It's my craft. That's different. Owning gold stocks is one of the ways that I increase my sort of gold. But they're different businesses. Gold doesn't require any work, just like a life insurance policy doesn't require any work other than paying the premiums. So I regard them as very, very, very different asset classes. In a different part of my life, in addition to being an investor in gold mining companies, I'm a speculator in the juniors. And relative to other people, I'm actually a better speculator than I am an investor. I'm willing to do the work. I have 50 years of mistakes, but there are three different buckets: insurance, investment, speculation.
And that speculation bucket, I think you would always recommend people have a very, very long time frame, correct?
Yes, and be willing to do the work. The more speculative the entity, the more psychological tolerance that you have to have for perturbation, and the more willingness you have to work. I have, as I think you know, Trey, graded tens of thousands of investor portfolios for free over the years. I ask people to submit them to me. I grade them for free. I've taught a lot, and I've learned a lot. And I ask investors to limit the number of speculations that they have in their portfolio to the number of hours per month they're willing to work on their speculations. Not got a hunch, bet a bunch. Read the quarterly filing statements, read the proxy statement, read the resource statement, read the insider filing statement. If you are willing to work 10 hours a month, by 10 hours a month, by the way, I don't necessarily just mean listening to podcasts, but rather reading filing statements, doing something like that, then you could own 10 stocks. But many of the portfolios that I've graded have had 65 or 70 stocks, and some of the stocks are unpronounceable to the holders. That's not good. Trey, I'll start by making a confession. Whenever I criticize speculators at a conference like this, if Bonnie, my wife, was present, she starts laughing, and she says, by the way, all the money that Rick invests conservatively, he made speculating wildly. So, yes, I have a fondness for it. I've participated in 3 precious metals bull markets in my life. This will be the 4th. And at some point in time, and I'm never smart enough to say why, you probably are actually, given your competence in technical analysis as an example. At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, I want to make more money. I really, truly enjoy the game. I'm 72 years old, and I want to experience that sort of quantum escalation at least one more time in my career, and silver gives it to me. When I came into business, I'm older than you, as you know. When I came into business in the 1970s, I witnessed an amazing silver market. The stuff went from $1.30 in 1970 to $50 in 1981. One stock that I was aware of, but I was too dumb and too poor to buy it, was Coeur d'Alene. It went from 10 cents, this is not a typo, 10 cents in 1970 to $65 in 1981. And that stuck, that stuck in a young man's mind. But I didn't participate. But as I think you know, in the later part of the 80s, the early part of the 90s, which was a spectacular silver market that people forget, I was involved in Silver Standard, which we took from 72-cent financing with a full warrant, thank you, to 6 years later, $45. And Pan American Silver from 50 cents, Ross Beatty was too cheap to give me a warrant, to $45. Those two moves from below $1 to $45 in 6 years stuck with me and have stuck with me forever. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it to the deterioration of the purchasing power of the US dollar that we're going to experience is the 1970s. In the 1970s, according to the Office of Management Budget, the US dollar lost 75% of its purchasing power. This is not some old fat libertarian Rick Rule saying this. This is the office, the Congressional Budget Office. I believe that because of the accumulated debt and deficit, particularly off-balance sheet debt entitlements and the unfunded entitlement liabilities, that the purchasing power of the US dollar over the next 10 years is going to decline by 75% again. I don't know how it'll be reflected in the gold price, but the easiest thing for me to say arithmetically is that the increase in the gold price will mirror the deterioration of the purchasing power of the US dollar. If that is more or less right, then the gold price goes up fourfold from here. People say to me, Rick, like, give your head a shake. Gold has already gone. It's already up 40%. If the analog is the decade of the 70s, let's assume that the move in gold price from $35 to $100 was a dead cat bounce off the restriction of the gold price. And let's say that the move in the gold price above 550 to 850 was morons piling on. That move from 100 to 600, six-fold move, is a pretty good move. And if the cause of it is the perception of the deterioration in the purchasing power of the US dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the US dollar. Well, you didn't. Well, you were alive then. We fought the war in Vietnam, which we lost, and we fought the war on poverty, which we lost. And the highest marginal tax rate in the United States then, before weird deductions, was 80%. So we couldn't raise taxes. We had to deal with these social obligations. We did it not by changing the nominal value of our obligations, but really by changing the purchasing power of the dollar. The second thing that happened is that the way that the fear of inflation was expressed in the market, or put differently, the experience that consumers had with inflation juxtaposed to the rate that they got on their savings meant that interest rates were sharply negative. We had a 10% measured rate of inflation. We measured it, of course, differently then. And people were getting paid 5.5% on their savings accounts. Well, that was reflected pretty clearly by a change in asset allocation from cash and cash equivalents or long-term bonds to gold. We have a circumstance today, Trey, where if your listeners believe in the CPI, they're pretty sanguine. You get a 4.5% yield in the U.S. 10-year Treasury. In a currency where your purchasing power is deteriorating by 2.5%, you're getting a 200 basis point real yield. I believe that's ridiculous. The CPI is not a good measure of the deterioration of the purchasing power of your savings. For one thing, the CPI doesn't include tax. Do you pay tax, Trey?
A little bit.
Yeah. If you look back at the basket of goods and services that the Reich family consumes, say, I don't want to test your memory and go too far back, but 2020 to today, gasoline prices, up 2.5% compounded? Hardly. Mortgage rates doubled. Groceries are a political issue, up 60%. And they're telling you that the deterioration of the purchasing power of the US dollar is happening at the rate of 2.5% a year? I mean, what they're smoking is not legal to transport state to state to state.